Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA data, but we're going to break it up into 4 segments. We're going to really look at the overview, what does everything look like. We're going to talk about refined products specifically, some global and US consumer trends, and then really kind of digging in on exports. And the idea is to really hone in on some of the key changes that we've seen as COVID has adjusted across the globe. And the one thing that we really want to keep focusing on is that question of the day. And now that we've had the crude rallying here, the question now is, does gasoline get back to normal? Because that's really what people are buying here, is the miles driven and gasoline demand will be back. I think Genscape said right now that it'll be back to 2019 levels by August. So we'd love to hear what you think on gasoline demand and if it really is going to come back to normal. So now that we've covered that, let's really dive into that crude stock build. So the number was bigger than what was posted because you have to factor in the SPR, which is just the Strategic Petroleum Reserve. And so we came in at about 6.26 million barrels on a build level. Now you can see it was pretty uniform in terms of where it came in based on where imports really have been surging, which is obviously Pad 3 and Pad 5. Pad 3 being the Gulf of Mexico, Pad 5 being the West Coast. So those are the 2 areas that saw the biggest increases, and then Cushing also saw an increase. And the reason why we're starting to see builds again in Cushing is because Gulf oil flow is at the lowest level since Harvey. And that's really going to come back to how many imports we have, which we'll talk about in a minute. And when we look at where storage is, we have to look at production. So right now we have shut-ins, based on Genscape, where they're totaling about 1.4 million barrels a day. But we also have Alaska, which has so far brought back 64,000 barrels. And Conoco has talked about bringing a total of 100. So we still have about 40,000 to go. And we're going to continue to see some more ramp-ups, especially with crude staying here. So the EIA is reporting 11. We still think that it's about 10.7, but given how quickly things are normalizing, we could see getting back to about 10.9 or that 11 million barrel a day number relatively quickly. So we'll talk a little bit more about what is really what's the composite of that next week. But today we're just going to stick to oil and really what the different refined products are doing. So when we think about where all the oil inventory is, you can see that we've hit a new seasonal all-time high. So clearly, we've had worse times, especially in 2016, 2017. So we have to consider, seasonally adjusted, this is the highest we've ever been, and given where the different competing factors are, we should see this continue to grind higher, especially with some of the builds that we've seen in some of the products. And when we look at the different areas in which the builds are occurring, we have to focus on really Gulf of Mexico and Pad 3. So you can see we hit an all-time high, seasonally adjusted. Again, we have to take away the fact that March was that high in previous years. But you're seeing that we're seeing this increase, and the increase isn't going to go down anytime soon, given the amount of new floating storage that is sitting in the Gulf of Mexico, which we'll show a chart of in a moment. So these are things that we have to look at when we're considering what the prices are going to do in terms of the different spot and realized prices up and down the United States. Because you have to consider, DAPL had the pipeline in North Dakota the judge is telling them that they have to shut down by August 5th, which is really going to impact where is North Dakota crude going to go. Their commentary is that there's about 200,000 barrels a day of spare rail capacity, but it costs more. So if it costs more, you need to price it at a discount, which is going to continue to whittle away from what the realized prices are for the E&P. So this is something that's going to start impacting the way Canadian imports are going. You're going to probably see a little bit increase in Canadian pricing just based on you're going to have more people pulling that down versus North Dakota, which is really going to impact the way crude is moving and how prices are realized. So when we think about imports, this is why, talking about the key capacity, you see in Pad 3, we had a big increase like we said we were going to have last week. This is even larger than what we were assuming. But again, it's all timing. So we had an increase of about 1.8 into pad 3 per day, and that's something that's going to start to normalize and come back down, just given timing delays. But we will see an increase in imports over time, over the next, I'd say, 2 to 3 weeks, as some more Canadian flow comes down to offset the loss of North Dakota. So those are things that we're going to kind of go back and forth with. Pad 5 had a little bit of a slowdown on imports, but again, they still remain relatively robust, just given where the amount of floating storage sits. And crude runs had a nice little pop. They were up 2%, up to 77.5. But the bigger issue here is we've already had commentary from PBF and some of the others that they're going to start reducing runs again now that we're past the peak driving season. So typically, when you're thinking about summer driving, typically July 4th holiday is the top, and then we start to come off from this high. So it's important to appreciate the fact that on the seasonal level, we should see an increase and then a normalization. And just given where storage levels are, we think that that's going to continue. So after this increase, we'll start to come back specifically in pad 5 and pad 3. Now, implied demand was interesting, and then we'll go into a bit more color on the different pieces of it. But again, gasoline had a nice little pop, of 200,000 barrels a day, which really isn't abnormal given, again, the time of year. The bigger problem is the big drop in distillate fuel. Now, this is something that we said was going to happen. This is even larger than what we were assuming, and it was really driven based on just, obviously timing because people were away. You had the long weekend. So you have to think of the holiday effect that's also going to hit distillate, which means that we'll get a little bit of a recovery next week. So we really have to kind of dive into some of these different components when we're looking at storage. So we've had storage in the Gulf of Mexico increase, and it's starting to come down. This will accelerate over the next 2 to 3 weeks. So far, we've almost wrapped up the floating Armada that came over from Saudi. That is almost done, but we do have some other purchases that have come in, which will be one or two here or there, just given timing delays. But you can see we still have this inordinate amount of, on a seasonal level, of crude sitting offshore. And this is something that's going to continue to weigh on storage, specifically in pad 3. And now when we talk about Saudi, we have to really consider, where we are normally. So the imports increased, and this increase in imports essentially wraps up. We might have maybe one cargo left of the Saudi Armada that came over that was purchased when prices really collapsed. And so now it's going to start being a bit more of a mix in terms of Mexico, Nigeria, and Brazil in terms of trying to offset the loss of that floating storage over the next couple weeks. And here, again, this is just a matter of looking at where imports were, and you can see the huge spike. Now, it kind of averages out, but you have to, again, it's all a matter of timing. And so the timing delays are going to set this back, but just given where pad 3 refinery throughput is sitting, you're still going to see that hang around more of the, a little bit below the 5-year average as we go into next week. Now, just to consider where refiner utilization is, last year and previous years, we were typically between 94 and 97%, depending on where we are. And we are still sitting at 77%. So it's just worth appreciating the fact that this is typically the last increase that we see on a historical level, on a seasonality basis, that we should start to see this level off. Now, given where we sit and how low we are, it won't be a huge drop off, but it will be more just kind of a sideways move as we go through the rest of summer. Now that we've gone through an overview of the overall numbers, let's really focus in on and dig in to the refined products. So the one that we're going to kick off with is distillate. So distillate is we've now reached the new all-time high without seasonal adjustment. In order to see where we've been before, you have to go back to 1983 for the amount of distillate that's sitting in storage. Now, again, there's a certain holiday factor, but again, you have to consider that even without the holiday figures, I mean, these are frightening numbers in terms of where refiners are sitting and how are they going to actually create product. Because, you can't create diesel without creating gasoline, and you can try to create more gasoline by minimizing your distillate cut, but it's going to be really hard for the feedstock in terms of these adjustments. And you can see that it was pretty much a clean sweep with builds across the board, with obviously pad 3 seeing the largest. And again, it's going to come down to, do they start to issue bigger discounts to move distillate offshore, which we'll talk about in a little bit in terms of exports. But this is also a key factor for industrial production, industrial growth, industrial movements. And this is something that we have to look at and appreciate as we go through July with some additional rollbacks and shutdowns as COVID, increases in different levels. So this is something that is going to be concerning, and especially from a refining perspective, where they just continue to try to lose less money. No one's actually making money on a refining level, but it's how do we lose the least, which is going to be interesting as we move through the remainder of the year. And when you look at just the demand, you can see the drop. Typically, if you just want to look at the seasonal level, we normally have a drop at this time of year, just given the holiday, people taking off, things are a little bit light, the week of and then the week after. So we should see a little bit of a continuation, not at the same level, but we'll get a little bit of a snapback. It's just, this is really kind of honing in on the underlying economy and what strength looks like on a shipping level, on a production level, on an industrial level. And this is why we talk about this more than gasoline, just because gasoline is going to react, it's going to have adjustments, especially during the summer, but this is really kind of indicating what's happening beneath the surface, which is why it's so important. But it doesn't, when we think about distillate and where that consumption is, we have to think about, rail, ship, and trucking, just in terms of moving stuff. And you can see the rail numbers, continue to disappoint across the board. Now, we knew some of these were going to be weak. It's just, it's continuously weak. And this is the weakness that has started in at the end of 2018, 2019. But you could have argued in 2019, the comps were really hard year over year. In 2019 into 2020, the comps were a little bit easier just because 19 was a slow year. But again, we're still seeing this overall loss in rail traffic. Now, there's a mixture of what is causing that, but the bigger issue is these large goods, these large movements just aren't necessary because we just don't have the demand to need the trains, the rail, the way we have in the past. And some of the key bellwethers that we look at to understand, what is the underlying economic growth is really metallic ore metals, in terms of total carloads, chemicals. Coal is obviously going to continue to struggle just because, we have more natural gas usage, less coal usage. And then petroleum and petroleum products. We're seeing a big decline, which is going to point more towards demand. But again, these are things that we're looking at on a regular basis. But you have to appreciate there's also some bullish components to it, and it's really trucking. So trucking has picked up, and it's because it's cheaper. There's a lot of spare capacity, and we're seeing a huge amount of movement. So FreightWaves is a company that does a great job in terms of managing and looking at trucks and rails specifically, and they've been calling out how trucking has really rallied and has now taken out the high that was established in March prior to some of these shutdowns as guys kind of rushed to get some of that product through the supply chain. And now you're seeing a similar rush to kind of backfill. But again, it's just really meeting the previous demand in terms of, the shelves are now getting restocked. I don't know if anyone has noticed that there's less dead space in the different food stores, retail shops. So that's what we're seeing here. But is it really going to continue? I'm going to say no, but again, I tend to be a little bit more bearish. But this is something that's interesting and is going to be relative a nice benefit and a nice tailwind to some of that diesel demand as more trucks hit the road. When we look at gasoline draws, you have to, again, put it into context. And that's the biggest thing, especially when we think about, okay, well, things are a little bit better on the supply chain, getting trucks, to the location, but what are the cars doing? What are consumers doing? So on a year over year basis, we came in with demand down 24%. And we had a draw, which is great in terms of, you can see where the draw was. It was in pad 1, which is the East Coast. And as more people hit the road and as we had less imports coming in, this was a benefit. We still have the imports sitting offshore, but we just have less coming in. And based on what the arbitrage is between Europe and the US, imports will continue to fall. But again, you have to consider where we are on a seasonal basis, and you can see how on a seasonal adjusted basis, we're still at all-time highs. And it's not getting much better because you have to consider that July 4th weekend is the peak of summer driving season. And when we look at where we are year over year, week over week, on a week over week basis, we had a decline of anywhere of about 20%. And that is a problem because now week over week, we're comparing more apples to apples in terms of driving season, but we should expect more in July 4th, not less. So the fact that we actually went down is a problem in terms of the trajectory. And then when we consider the year over year being down about 24%, you're going to see that this is going to start to weigh going forward. But again, the gasoline draw was good. And this is something that we have to consider. Is it going to continue? I'm going to say that it'll continue in a lesser amount, especially as refiners look to backfill, given that there's a little bit more space now in gasoline storage versus distillate based on what we've seen in the disty tanks. And, again, when we look at gasoline product demand, we have to consider this is a calculated number. So we did get an increase of 200,000 barrels based on what they've talked about, which again is nice. We went from about 8.5 to about 8.7. We believe that we hang around that 8.5 average through the remainder of driving season. And again, we continue to see slowdowns in Florida, Texas, and California, which are the three biggest consumers of miles driven and of gasoline, across the board. And what gives us confidence in saying that is again, the refiners within PADD 5 or the West Coast, specifically PBF's Martinez, they're telling you that, look, we have to cut runs because we don't see demand. Again, they're also trying to protect margin, make things a little bit more expensive to kind of capture some of that demand, but it's going to continue to weigh. So while people are getting excited about this is something that is good, but we think it normalizes over the next couple weeks as we come out of the holiday season. Now, jet fuel demand is one that's interesting. We had a little bit of a build, but again, we're seeing demand take out that previous high, but we also normally see an increase during this time period as well as people instead of driving, they normally fly. Now, instead of flying, they're driving. So you're starting to see a little bit of an adjustment. But again, this is an interesting component. When we see demand, we think it falls, as we go through the next week or two, and especially just given where TSA passengers are. You can see that we normally historically get a spike. We had one last year. We had one this year. It was clearly not, on the same magnitude, and that's something to consider. And we're going to continue to kind of roll off as people remain close to home, as we'll talk about in some of the consumer trends. As we've talked about the TSA and jet fuel demand, and we look at the movements of consumers, we thought it'd be a good time now to kind of break off and go a little bit deeper into consumer activity, how things have shifted, how they're trending. And when just going back to that TSA chart, you can see that we've kind of flatlined. We're between that 500 to 750,000 people, and just given where the resurgence of COVID, how things, move in closed spaces, it's going to be hard to see that really get back to normal. And we think that 70% decline really holds through this year and well into next year. And that's why when we talk about the consumer, we have to talk about mobility. And one of the interesting things when we look at Google data is, how the shifts have changed. And as less vacations are taken, people stay local to home, it's interesting to see that shift in parks. And you're seeing that, and that you saw a big spike into July 4th as people took advantage of the long weekend to go to parks, to go to different sites, just to get out, just to see different things, something new, something different. But again, you're seeing the declines really kind of hold on a year over year basis, and based on where the baseline was at the beginning of COVID. But this is also a time that things normally do change. We normally do see more parks in the summertime, just based on the Northeast and camping, other different components of how this data is calculated. But the bigger issue is transits are just not going to be the same. Retail recreation has started to come back down, as kind of normalized. These are things that are going to be consistent as we go forward, which is why we think that there's going to be a problem overall for total gasoline demand. And now when we talk about total gasoline demand, we have to think of, on a global level, just based on how mobile a lot of these products, specifically refined products, are. And when we look at, residential data, this Google's looking at, which is kind of frightening in its own right, but Google's looking at, how much are people staying at home, based on pre-COVID. And you can see there's more people just spending time at home. There's less travel, there's less movement. And this is really kind of driving what we're talking about, where there's nothing out there that's telling you, go out more, go do something different, especially when we saw the spike in cases from in-restaurant dining, which has created an increase in a spike. And again, you're also getting people, staying in their backyard, having people coming over, social distancing in their backyard with a barbecue, whatever, and avoiding a bar, a pub, a restaurant. So this is also something that's going to be reflected in the data, which is going to minimize the amount of miles driven. Now, again, like depending on seasonality, you might see an increase, decrease. As we go into the fall, winter season, you'll see that normally adjust in the Northeast, but things cool off in Houston. How many people want to go out today when it's 110 degrees with 100% humidity in Texas? But you'll do that in the U.S. in the Northeast when you have 80% humidity, 80 degrees, but again, things are going to adjust to keep that number, below where it's been over the, people staying home longer than previous times. And then when we talk about restaurants and people avoiding in dining, walk-ins, whatnot, OpenTable does a really great job of looking at seated diners. And you can see that we've maintained a global trend of down anywhere between 60 and 65%. And this is, again, going to continue just based on people concerned about jobs, wanting to spend less. You have people wanting to avoid being indoors too much, avoiding these close proximity meetings. And you can see it's continuous. Even though we've seen reopenings over the same time period, we're just not seeing people normalize. And it's because of that, just the limitations. California had in restaurant dining, big spike in cases. Those are things where, the Northeast, specifically New Jersey and New York, they've delayed the in restaurant dining because it's like, well, let's understand what happened in California. Let's not repeat that. And that's what we're seeing here. And when you can think about, okay, well, that was a global number. Let's break it down regionally. What has happened on a regional level? And you can see, Germany was the first to reopen. They've started to see things, normalize a touch. But again, you're seeing, and this is, again, year over year comparisons to see what was it last year versus this year, you're seeing a step down. Like people are adjusting the way they're moving around and going about their business. And you've seen in the UK, the US, that is going to be relatively sticky. This is something people aren't driving to the restaurant now. They're not spending money in the restaurant. Food prices are going up just based on inflation on pricing, and then people trying to cover their overhead. Australia is one where you had a big spike in dining over the last 2 weeks or so, but yet you also had an increase in cases with a brand new outbreak, which is being addressed aggressively to keep it from spreading. So these are things that are going to, we think, remain really kind of consistent through the end of the year, or at least through the summer, which is where people normally go out more. People, feel more active, and that's going to be a weight on not only, sales and consumer spending, but also on miles driven. And again, we come back to employees working. And this is something where we're going back to the home-based data, and this is the more up-to-date information. And you can see the rollover. Now, obviously, there's a holiday effect. People, offices are closed. Some retail shops are closed. But it's the depth, and it's the slow recovery. And we've showed the data in Arizona, Texas, Florida, California, where as COVID cases rose, you saw that roll off. And this is something that's going to weigh on people in terms of, well, I think one of the airlines just said, people's jobs are at risk again. So the question is, okay, well, if my job's at risk now, I don't know if I'm going to be fired. Am I not going to be fired? And that concern will keep people from spending the same level, and they're going to try to keep things close to home to kind of build that nest egg a little bit bigger in case they do get the unfortunate pink slip. But this is something to continue to watch. We think we've kind of peaked, and we're going to continue to go to the right. We get tomorrow, we're going to get information on continuing claims, unemployment. We think continuing claims remain over 19 million, which again is going to be a huge onerous capacity on consumer spending, and really where the future is on purchases, which is going to directly impact, how much does the industrial side make new product. And when we look at job seekers, this is an interesting data point because we're looking at, a large city is defined as 500,000 people or more. And you're seeing that we're getting a huge drop in the amount of people that are seeking employment and how recruiting is happening in those regions. Now, given things aren't normal, you have people that aren't in the office, everyone's working remotely. But the trend is, while up, it's still highly negative. And if you look at times in January of 2009, June of 2011, if you consider what those times were coming out of some depressions or economic slowdowns, you had an increase, not a decrease. And this is the shift. Well, are people not seeking jobs because they're discouraged and they want to wait? Are the employment benefits more than they would be making, so the employment benefits are keeping them from seeking a new job? Or is it something bigger? Is it people actually moving out of cities? Are people now looking to go further away? And this is going to impact not only commercial real estate, but just what the apartments look like, what rents look like, what the residential and commercial side look like within cities themselves. And that's where to round out this specific topic, we continue to track retail traffic. Now, retail traffic started to come off as we got into June. June got a little bit slower. We had retail sales up just because people were buying a little bit more. Delayed purchases happened. But you also had a significant amount of sales and incentives. And now that is starting to go away as well. Now, they'll come back, as people try to move more inventory. But this is going to be something that's going to be interesting, especially through July, where we've had a renewed lockdown. We've had, breakouts in specific locations throughout the South and the West Coast, which may keep people from entering a store a little bit longer. So we think that this is going to be a trend that's going to continue, through July, and then August will be interesting to see how people feel once some of these outbreaks come back under control. Now that we've really, gone really deep or deeper into the consumer, let's pull back out a little bit and look at, exports from the U.S. and where things are headed at this point, given how COVID is going and impacting, different trade partners and what that means for the U.S. and refining overall. So here we had another nice little increase of gasoline exports of about 41,000 barrels a day. But the distillate increase was nice to see. It was 294,000. Now, it's important to put that into context because the demand numbers are a calculated number from, the supply demand from the EIA. But we also have a certain amount of storage capacity as well. So if you're seeing an increase in exports, you should see some of those builds come off because it's stuff that's going onto a boat and leaving the shore. So these are problems. I mean, we had a nice disty export. Now, given things could have been sitting on ships already, and it was just a matter of how it was classified from onshore or exports or loading. So these are timing delays that will also show up. But again, this is something that's relatively interesting, especially with where things sit overall. We think gasoline exports are going to be flattish to down. But we think distillate exports could actually see some support, which we'll talk about in a little bit. The bigger issue here is the oil exports. So oil exports, again, it's always going to be, give and take. If we had a lot of imports, that some of that infrastructure is required for imports, so we're not exporting. So again, this is going to be timing delays. So now this week, we're going to see a little bit more exports, a little bit less imports, again, as things switch. Now, if you look at what the OSPs have been, which we'll talk about tomorrow, and what Saudi has done, we continue to see a renewed support for U.S. crude, just given what pricing looks like on a global level. So that will help support U.S. exports at about, let's call it 2.7 to 3 million barrels a day. So that's something that we think will recover over the next week or two. Now, when we talk about gasoline, we're just tracking the 5-year average. We need to really focus on what's happening in Brazil, what's happening in Mexico, because these are key export areas for our product. Mexico, it continues to fall into a deep depression. You have COVID cases. They're reaching new all-time highs and really competing with, in the worst way possible, with Europe for some of their cases and death rates. And Brazil is facing something very similar, which is going to continue to be an issue for how our gasoline exports are going. The other problem that we're going to see is just, what does the competition look like? What are European products doing? Or if they're not going to the East Coast, are they going to Latin America? And that's why we're confident in saying that we're going to hang around the 5-year, probably average something below the 5-year average. But this is, again, something that's going to be relatively consistent over the next few weeks. Distillate is interesting, and distillate is one where we saw another big increase in exports, which is good to see because it's getting stuff off of our coast. But at the same time, we have all-time high distillate in storage, or at least not seen since 1983. So we have a reason to get this stuff out in order to keep storage available for refinery runs and throughput. Some of the data points that I thought were interesting is just looking at, global diesel stockpiles. So when we're looking at it, they've fallen from the peak, which was about 25 million barrels in mid-May. They've fallen about 46%, according to Vortexa, which is good to see. You're getting a bit more absorption as countries start to reopen. India's pulling in some more. And again, good to see, but we're also seeing exports increase of refined products from China, from India, as their refiners come back online. And there's this weird dichotomy of, well, how much is onshore, how much is demand, and well, we need to try to make some money at the refiners, so we have to increase exports. So we think that the decline in floating storage is going to come down, but again, it's coming down is still a good thing in terms of U.S. exports and trying to get into the market. The other benefit that we're going to have is the decline of Middle East and Indian, I shouldn't say just Indian, but Asian flow into Europe of disti. That's starting to slow down, which is going to be supportive of U.S. flow going back into Europe. But again, we're coming towards the end of the seasonal shift, so it'll be kind of a give or take, which is why we think we're going to be a little bit above the 5-year average over the next 2 weeks or so. And when we look at inventories across the core regions that we talk about, this is where we continue to focus, because the U.S. obviously had big builds across crude and distillates, but Japan had a drop in crude and storage by about 1 million. Distillate dropped, but the distillate drop was actually driven by exports. So it's kind of a give and take, where it's not being registered in Japan, it's floating. And Fujairah had a nice decline. So you can see that the U.S. is the one really kind of keeping us flat, which is what we expect. We think there's going to be kind of ebbs and flows across these 3 key regions for exports exports overall, in terms of where do ships refill before they go into the next leg of their journey. And that's why we think we're going to kind of hang here, which again is leaving us relatively bearish through the end of the summer, just because we're going to see these competing factors as crude builds remain sticky and distillate builds are seem to be on an upward trend, specifically in the U.S. And when we talk about exports and we talk about the way ships are moving and how things are needed, we have to really appreciate the daily activity indices, which is an interesting way of really kind of factoring in what is happening within the different countries and really taking a broad look at the consumer industrial levels. And here you can see, things have obviously come off the bottom, but we're starting to see this plateau and kind of, things going to, sideways. The bigger drivers that are seeing an outsized benefit remains France, which is a positive, in Germany. Italy is starting to catch up, but you're starting to see some of this kind of flattening out in Spain and Italy in terms of reopening and flow. the bigger problem, which is going to be a hindrance for exports and really, some decent bellwethers, just given the size of their economies in the global construct. That's why the U.S., Japan remain a key focus for us, because again, that sideways movement is going to have an outsized impact versus a French recovery. And that's why it's good to look at all of these different things, because a French recovery is good for the U.S. distillate exports. So that's going to be supportive of things coming off of out of the U.S. But when you consider what moves from Japan in terms of microchips, advanced technologies, you're seeing that you're not really getting the production move that we would hope at this point in time. While PMIs have been good through June, we remain concerned about them through July and into August. And that's why when we look at key recovery factors, it's an interesting way to look at the different metrics. And it was Bloomberg Economics put this together, and it's interesting because we're seeing new COVID cases on the rise. We've had new records, but again, deaths are not going to be the same. Why aren't they going to be the same? Well, we've adjusted the way we treat. CPAP, no vent, positioning, steroids, anticoagulants, forced dehydration to take fluid away from the lungs. These types of nuances that we've learned over the last couple of months is going to help reduce that death rate, but it's still going to require hospitalization, ICU care, which is going to be a bigger issue when we're considering how the infrastructure can handle the rise in cases, which is why the lockdown index is going to remain relatively sticky as COVID cases continue to rise, because you have to make sure that you have the hospitalization, the hospital flex capacity to really manage that. Now, and the bigger issue that we continue to focus on is jobless claims, because while it used to be more of a lagging indicator, based on the indications from companies, we're seeing another increase in jobless claims that we expect through the summer to remain relatively sticky, keeping the continuing claims elevated, and that's going to keep some of those real economy indicators really flat to down through the end of the year. But then if you look at the financial markets, who cares? Everything just goes up. So these are different capacities that we have to look at and try to weigh, because the financial markets, while not a clear reflection of the economy, we also need to appreciate that earnings are going to be impacted as we go through not just Q2, but into Q3 and Q4. So next time we're going to talk about OPEC plus production. We're going to look at OPEC, OPEC plus, non-OPEC, and then really what's happening in just global storage and those global refined products. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.